So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani, and I am joined today by Scott Williams. Scott is a managing partner of Aline Capital and is also head of the firm's capital markets division. Aline Capital is a fully integrated investment sales and capital markets firm specialized in the middle market transactions. They offer debt, equity, and structured finance, as well as investment sales advisory services throughout the Southeast. Scott, welcome to the show.
Hey, thanks so much for having me. One thing that has not made it into the description yet, we have actually just launched a third vertical at Aline Capital. We're doing commercial and general liability insurance for investment real estate. And we started that because we started seeing a lot of headwinds in the insurance market. We had some deals fall apart because they couldn't get insurance, or insurance came in really surprisingly high. And we can't make your premiums any lower, but we can really control the level of customer service you have on that. So we're licensed in North Carolina, South Carolina, Georgia, Tennessee, and Alabama for insurance as well.
Wow.
And offering that as a third party, and as well as to our clients, to help everyone's life a little easier on that front. So
I love that. And I was going to say, as soon as you said it, I was like, I guarantee that they had an issue with it somewhere in one of their deals, because that's usually what leads to the integration, and that's adding the vertical.
And so we found, and I don't blame anybody, but we'll have a $28 million apartment deal, which is a decent sized loan for us. It's got like a $70,000 or $80,000, insurance policy. And some of the big groups, aren't even getting out of bed for that, because they're chasing more six-figure and higher premiums. And it's like, man, if we have a $28 million apartment deal fall apart because we couldn't get anybody to get us insurance in time for closing, like, this just doesn't make any sense. So as a cross-sell, but really as a customer service aspect for our clients. So we're excited about that, and hope we can do good things for our clients and other investors with that service.
I love that. That's fascinating. $80,000 premium, and these guys aren't getting out of bed. What a fascinating industry to be in right now. Just things are going up and up and up. I love it. I mean, it's obviously great, but it's will be interesting to see. And I know we're going to get to some of that stuff, so I'm excited. But sure, I'm going to take us back a little bit. Were you always in this industry, or where did you start before, and what led you to where you're at now?
Yeah, so I kind of grew up in real estate, from early childhood on. My dad was a real estate appraiser, both commercial and residential. He was actually internal appraiser for a bank. He turned commercial real estate broker, kind of a master generalist, just with his appraiser knowledge, early 2000s. So that was kind of like middle school, high school years for me. And so got really interested in it. So the week after high school, ended up getting my real estate license, went to Clemson here in South Carolina, was a real estate major, finance and real estate major there. That was great. Graduate, always thought I was going to be in real estate, worked in the summers in the real estate office, had some success doing some sales while I was in school, and then came out, graduated from school in 2010, and kind of mid crash. So like my junior year, 2009, and senior year, we're kind of walking around like the business school, like, we're not going to have jobs, like, so I always thought I'd be kind of a broker for one of the nationals, maybe a CBRE or Colliers or something like that, because they always had these strong brokerage associate positions. So they come in, they pay you like, $30,000 or something. And then you work for your team and get a little cut of the team. And you do that for maybe 18 months, 2 years, and they promote you. But there were no paid jobs during that. And I did not want to move back home. So, I was looking for like a paid gig, and it was interesting. It was the biggest blessing ever. I went and worked for this company that was starting up. We were an outsourced underwriting firm for a lot of the Fannie Mae, Freddie Mac, HUD, and CMBS lenders across the country. And I was like 8th guy in the door at that company. And I left 5 years later. We were over 60 people. I'd ridden the ranks pretty hard. The vice president, was running a team of underwriters and doing a lot of great things there. And it was just great. And then, so the premise of that firm was, during the crash, a lot of firms had laid off their back office, but when the market started to come back, they would hit capacity on what they could handle internally pretty quickly. So outsourcing became a pretty good opportunity. And the outsourcing was a bunch of veterans from the industry outside of the new grads that were analysts, a bunch of veterans from the industry that used to work for those shops anyway. We're just getting them and they weren't having to carry their overhead. So it ended up being a great thing. And we got exposure to so much. We did some workout work on the asset management side, but overall in the 5 years I was there, did like over $2 billion worth of deals all over the country, different asset classes, just incredible exposure. And so, while I thought I was always going to be on the asset side, like the investment or the investment sales or leasing side, fell into the capital markets side on accident and ended up just falling in love with it and stayed in it ever since. So I started Aline Capital in 2015, and we were just debt and equity brokerage for 5 years. Then January 2020, we launched investment sales, and it's been, that happened right as COVID hit. We had a lot of momentum. COVID hurt, but we were still profitable with great trajectory, and it's just been a great thing ever since. So really, really excited and thrilled to be in the industry, fascinated by it, kind of nerd out in it, if you will.
I love it. I can hear your enthusiasm and your passion. It's contagious. Couple things. Explain for the listeners who may not know what capital markets and middle market is.
Yeah. So capital markets, technically defined, are like the markets in which debt and equity are raised, but that's across like all investment asset classes, right? So it does not just pertain to real estate, but just in terms of, in the true big shops, the lenders and the banks, like capital markets entail so much more, and they're actually trading the bonds and, selling paper, tranching out things. We're trying to put financing together, full capital stack. So debt being a loan, right? Debt being financing usually from a bank or from a debt fund or from, an agency lender, right? So, anything from senior debt, that first mortgage, that first loan you get, all the way up through, mezzanine right behind them. And then we try to do preferred equity and JV equity, really high up in the stack. So that's what we mean by the service we provide there. And then middle market, we're in the Southeast. So price per pound, we have some big markets here, Charlotte, Atlanta, Raleigh, namely. Obviously Florida has a bunch of big markets, but in terms of deals that are over $50 million in a lot of our secondary markets in the Southeast, I think Greenville, South Carolina, Charleston, South Carolina, Greensboro, Winston-Salem, Chattanooga, Huntsville, Alabama, those types of places. We're really in a sub-institutional world. None of those markets are really called core, and just price per pound and dollar wise, I'd really kind of consider us middle market. So, some people would probably define middle market higher than we do. 2 to 20 from a sales side is really bread and butter for a lot of our brokers. I'd say, we're on the capital market side, we're lucky enough to get above there somewhat, 30s and 40s $1 million deals. But really kind of that sub-institutional middle market is where we try to play. And, the institutional markets get a lot of good advisory and guidance. And we try to, in a lot of my, knowledge and training was in sophisticated markets. So try to deliver sophisticated knowledge to the middle market that isn't used to having, that level of advisory and sophistication brought to it. How do we put a multi-level layered cap stack in on a $25 million deal? Well, sometimes that's not something that typical investor has heard of. So trying to bring a high level of knowledge to the middle market is kind of our firm's, really mantra.
I love that so much. That's incredible. And like you said, definitely recognizing a need there, because so many people start on that lower, and guys, middle market is quite literally in the middle, right? It's like between basically retail and institution. So it's exactly how it sounds.
Sure.
And I didn't know that in the beginning. And I was like, what the heck is the middle market? And I looked it up and I was like, oh, it's quite literally in the middle.
Yeah.
But yes, which is a very, the middle market is changing in terms of, it's still the same, but like the actual size of the asset is changing, probably shrinking a little bit because asset prices are going up, even in these middle secondary markets. But that's awesome. I love that. And thank you for that explanation. So, you mentioned that you got, a ton of exposure when you were working for the third party underwriting and all of that. So you're very in tune with, what's going on in like the interest rate market. So kind of talk about, interest rates, cap rates, people hear interest rates going up, they assume cap rates have to go up. So kind of talk about all of that and the correlation and what we're seeing.
Yeah, no. So I'm here to break big news on the show today. Interest rates are going up.
Whoa.
For those of you that have been under a rock for 5-6 months, interest rates are going up. But yeah, it's interesting. Interest rates are definitely going up, and I love trying to take an academic approach to a lot of this and diving into how will that affect pricing, how will that affect the market, and all that kind of stuff. And it was probably 2013, 14, maybe, where I had, we were experiencing interest rates rising, and, I had even written an internal memo to like our folks, like, hey, interest rates are going up quite a bit. You're probably going to start seeing cap rates come up. Let's start looking at our appraisals from 6, 12, 18 months ago, watching cap rate trends. If you see some compression during this time, it might be a red flag. You should definitely guess it. And we didn't see it, right? Cap rates actually went down, pricing got more competitive. And so what we saw during that same time, and I went to a presentation with Sam Chandon, who at the time he was still at Wharton. He was one of the chairs at Wharton for a real estate program. He's an economics guy, he's a brilliant guy. He's now the dean of the NYU real estate program or Shack School, and brilliant guy. And I went to this presentation, and he was just talking about the other side of the equation, obviously, is return expectations. So as interest rates are coming up, what happened in that period of time was equity return expectations were compressing so hard that it was actually stagnating and bringing cap rates down. And I was like, oh man, I didn't even think about the other side of the equation. I was pretty inexperienced at that time. And so I had this conversation we're in Greenville, South Carolina, the Clemson Masters Real Estate Programs here. I had a breakfast with the dean of that school the other day. I was like, I'm just going to kind of step back and try to be an academic observer this time, and not try to make any calls. But I was like, man, we're kind of at rock bottom returns outside of large value add plays. And with interest rates going up this time, you got to think cap rates stagnate, even start to go up. He kind of tended to agree, but I was like, I'll just see what happens. And beyond those two things, I was actually I was in New York at the IMN, did a good mezzanine and high yield conference last week. And they had some really great speakers with lots of assets in the room. I mean, you had Apollo, Fortress, Blackstone, really, really sophisticated investment groups there. And one of them kind of made the mention that this time around, we've seen that flows of capital and availability of capital have impacted cap rates even more so than interest rates and perhaps return expectations. And I thought that was really interesting. And so every time I try to make one of these hot calls, it seems like the market seems to find like a market-based solution for why things are happening, outside of probably just the popularity of maybe multifamily investing. You see these things happening, but I do want to talk a little bit about how I anticipate it, impacting cap rates. And, for the folks that are in the camp of like, man, all cap rates are going up, interest rates are going up. It's interesting because a lot outside of value add scenarios, value add multifamily, value add anything, outside of multifamily scenarios, if you're looking at a stabilized product, it's just someone's buying for just kind of a longer term hold or a yield, we're probably putting that in a permanent debt market that prices over the treasuries, right? And, if you've got a 10-year loan, that's going to price over the 10-year treasury. Well, the 10-year treasury has already baked in all of the Fed's forecasted moves that they've been telepathing. And for right or wrong, if the Fed's been right, have they been wrong? What they've done really well the past two times is really try to telepath to the market what they're going to do. so that the market can bake it in and it's well absorbed before it actually hits. And that's actually extremely helpful to the market. But if you look at the 10-year treasury, it's kind of made its move, right? I mean, we're expecting 50 basis points on the next meeting, potentially 50 basis points in the next. Will it be 25? Will it be 50 basis points in the fourth quarter this year? We'll see. If it comes in that it's 75, that might move the market a little bit. But outside of, some things, black swan events or something really shocking the system, the pricing moves on interest rates for all permanent, and that includes things coming off new construction and all stabilized assets, they've already made their move. And so maybe we saw cap rates move a little, but in most markets we didn't. And so I would say I'm not anticipating this overwhelming repricing of the real estate market and drops in values. Specifically, what will face the most headwinds is value add multifamily. And that is because the cost of capital for that space was extremely low. And what we were seeing was floating rate debt based off of LIBOR turned SOFR, and 1 month LIBOR replaced by SOFR for your listeners. That's your floating rate index on most of this stuff. And that went all the way down to zero, basically 0.05. And so we were writing a lot of this debt with, extremely low floating rate indexes. And although the Fed moves the Fed funds rate, they really impact all short-term interest rates. And so every time you hear the Fed, hey, we're doing another interest rate hike, that doesn't impact the 10-year treasury. The 10-year treasury is already baked in the Fed's telepath next move and actually the next one. But so that's not going to affect your interest rate on your 10-year loan, but your short-term loan that's floating rate base, that's going to catch almost that entire hike, right? And so you literally have guys that started investing, that purchased deals in 2022, and their floating rate index was 0.25. And that's probably going to be 2% to 2.25%, if not higher, by the end of the year. So you have people that started at maybe some of our best loans were 3.5% over the floating rate index. So 3.75, right? That index is now going to be 3.5% over 2 or 2.25. That's 5.5 to 5.75 money, right? All within a 12-month span, maybe sooner. And I literally this afternoon was on the phone on a deal. It was a 70s vintage asset, had been under contract at like 120 a door. And this was in the Southeast. We're under NDA, so I'll give generalities. But it was under contract at 120 a door from April, and it fell out of contract. And I just got off the phone with the broker who's saying we're taking it back out. It's probably going to trade about 105 a door, 107 a door, right? And it's because the loans that those deals can get, if you're starting, you might have a 3.5% in place cap rate on that cash flow. If your interest rate's above that, you have negative cash flow for a ramp up period where we haven't really had to anticipate that yet. So we're seeing some repricing in that market. We're seeing a lot of hesitation for deals to come to market. But one of the most profound things I also heard at that conference last week is, the good news is there are a lot of people that get paid to put out money, right? Banks get paid to put out money and they don't want to lose money. Lenders get paid to put out money. Equity groups get paid to put out money. And there's so much money on both of those sides that while there's some price dislocation right now, one of the gentlemen on the panels in New York was just like, there's so much money out there. There will be a market-based solution for this.
Yep.
And while we think it will take some time to dust settle, one of the big guys, I won't say who it was, one of the big guys was like, just frankly, we're out till probably fourth quarter this year. We're out of the market. We're just watching it. But we're expecting a lot of transaction and price discovery to have settled and pick back up later this year. And I think that'll hold true.
Absolutely. I've actually been saying this the last couple of weeks, is that the way that we're set up now, right, with everything that obviously happened in 08, in terms of like institutions, banks, everybody, kind of obviously watching indicators, of course, laws were put in place, but essentially what you're saying, where capital is now just waiting. And as soon as that drop happens, wherever it happens, that capital is going to go and reinflate that. So you're not going to see that big, so many people are like, oh, I can't wait for that, 12 to 20% drop. And you're like, first of all, it's going to be like a 4 to 8% drop. And it's going to happen so fast. It's like, if you're not ready, you're going to have to strike when the iron's hot, and then it's going to be cold again, because we're no longer, over leveraging and doing the things that got us in trouble before. And so now this capital is just ready to go reinflate wherever that drop occurs. And so I just don't see, listen, like I said, people have always said this, but I just don't really see where it can happen to a degree that's, really sinks an entire economy, global economy. Now there's things happening overseas. Europe is obviously in turmoil. You got the war. They're having their own inflation issues. Do you see any of that affecting us to the degree that it happened before?
So that's the biggest challenge that I think everyone's facing right now, is that there are several inputs into what is impacting us right now that are complete X factors, right? The Fed has been critiqued for saying that the supply side of inflation was transient. They weren't completely wrong. It's just that it's not over yet. China has shut down again and has just started to open back up. There's still so much supply side, impacting the inflation factor, on top of the war between Russia and Ukraine, which is unique in terms of inflation to any other two countries fighting, because Russia supplies the vast majority of Western Europe with oil and a lot of the world, and we're trying to boycott them. The flows and supplies of oil impact inflation for everything else, because diesel fuel has gone up tremendously. And if the truck delivering your eggs and milk and bread, it costs them way more to get there, they can't eat that long term. And the war's been going on for several months now, and there's, not a really called end in sight, right? So these aren't your typical inputs that the Fed can just say, we're pinpointing these, which is why I think, if I had to bet, the Fed is like talking a little bit outside of where they think they're going to happen to appease the market. The market participants have been bound in their desks. Like, you got to do something. You got to get in front of them. You got to do something. I'm not smart enough to have insight into their data on what they're looking at, but I kind of get the feeling that they still think a lot of this could bake out, which could settle rates down all over the place. Now, the other biggest X factors, we've kind of had these two black swan events in the past 2 years, right? COVID actually was a repeating black swan event. And then the Russian-Ukrainian, conflict, or Russia's war on Ukraine, that's kind of another black swan event that's impacting all this. And so time is our friend, which more than anything is, I think, why some of those bigger guys that are smarter than me and have the data are saying fourth quarter, there's going to be pricing discovery. But I also think they're expecting a lot of this stuff to bake out. But yeah, so many X factors in the data. That's not traditional inputs that you can kind of think about or maneuver around.
Yeah, it is fascinating, right? And it feels almost like we're actually progressing economically as we should be, in terms of like, we learned our lesson, and so the same things can't happen again. And so we're just seeing something new that we've never seen before. So no one knows what's going to happen. And that's how, personally, I think progression should work.
Sure.
Is new problems, essentially.
And there's liquidity in the capital markets, on the debt side, on the equity side. 2008, the banks seized, right? The credit markets just seized. The credit markets are just kind of like, all right, we're watching this. We got a lot of money to get out. We're happy to transact on good deals. Nobody's underwriting standards have slipped. No asset bubble is driving this inflation. So as soon as we kind of figure it out, there's going to be money to place. But I will say, I think that capital stacks and how we transact is going to be different, at least in this higher interest rate environment. Purely on debt service coverage requirements, higher interest rates with maintained debt service coverage requirements mean lower loan amounts, right? Lower leverage. So there's going to form this hole in the capital stack of where the sponsors want to put in money and where they can earn return on their money, and then where the banks want to be, right? And so, or where the lenders want to be, because we work with a lot of non-bank providers, but that's where that market-based solution I really think is going to come in. I think you're going to see a lot more mezzanine financing. I think you're going to see a lot more preferred equity. And that's kind of where, our firm's kind of chomping at the bit. We've been thinking this is going to happen for a while. So we've really tried to harness our and really expand our equity relationships. And we're very analytical. We try to, when we start looking at a deal, we started at the kind of the top of the capital stack down, because, and the reason for that was debt was a commodity for the longest time. I mean, you could call one lender and get 4 term sheets. Now you got to call 4 lenders to get 1 term sheet, maybe, probably worse odds than that. And it takes a lot longer and it's much more rigorous of a process. But, if you start solving it for what does the equity look like, and maybe I need to push the debt down a little bit to, entice an equity group to come in. But, especially on a value add deal, if you can put mezz financing or you can put pref financing in that has a capped upside, capped coupon or capped pay rate, like, they go home after they make 10 or 12% on the deal. Well, any additional upside you can create above that is positive leverage. And so where senior leverage, maybe they want to be at 65% leverage. Okay. Historically, we've been leveraged at 75. Well, mezz and pref will go up to 85, 90% leverage. If we can create positive leverage up the stack, I think it's going to look different this time. And so I think having those conversations now are really important, and folks trying to establish those relationships are going to be really important for when pricing discovery does hit and it's time to transact.
Absolutely. I couldn't agree more. We're really going to see a separation now of those that have, I don't want to say gotten lucky, but more or less enjoyed the market and kind of gotten luck, right? Like enjoyed the market and haven't really had to understand the business side of this, right? And the finance and economic side of this, and have just been able to go out and do acquisitions, versus the ones like yourselves and the top operators who, are forecasting this and have analysts who are paying attention to this stuff.
Yep. Yeah. This market's not going to bail a lot of people out. There's some headwinds and the tide is going out for sure. So.
Yeah, absolutely. It'll be interesting to see. And, again, like those top guys are saying, I do think we will see a bit of some distressed assets on the market, but they really will not last long.
Right.
Because people are ready for it this time. So awesome. Well, I can't thank you enough. This has been incredible insight. I do have 5 questions I ask all of my guests. We'll jump to the final 5 here.
Cool. Okay.
First question, best advice you've gotten from a mentor?
Success is a journey, not a destination. It's more about how you act while you think you're getting where you're going, because you never actually get to where you think you're going.
Wow. That was huge. Love that. What is it about your career that makes you feel like you're fulfilling your why?
I'm very passionate about creating and what we're creating here. And so owning the business has just been phenomenal, and, trying to instill passion into the folks that work with us and younger folks. I mean, truly thinking like we make a difference, that's what I hang my hat on, and trying to always create and grow and better it for our employees, for our clients, and their families. Right. So.
Absolutely. Yeah, it is tough. I was listening to a podcast with Joe Fairless, and he was like, the thing you need to, once you start bringing on employees, is what you need to understand is they're not as passionate about the business as you are. Right. And it's just a natural thing, of course, right? It's not like you're hiring people who don't care. It's just their priorities are different, right? They care more about
Absolutely.
their family than they do their business. So it's important when you bring on those employees to obviously find people who are passionate about it and care about the culture, but also, like you said, taking care of them and making them feel like a priority as well.
Yep. No, you bet.
Favorite non-real estate or investment related book?
Favorite non-real estate or investment related book? So in not business related. Okay. So
Yeah, business related.
Yeah, no, I've just got, the book I kind of treat as Bible is The Road Less Stupid by Keith Cunningham. And it just resonates so well. He starts off the book that, hey, not everything I'm going to say is going to apply to you. You need to read what I'm reading through your filter. Just kind of one of those guys. But man, The Road Less Stupid is kind of a book I really treat as Bible. But outside of that, I'm really excited about a new book I just got, Life Force. Tony Robbins is kind of the headliner for it, but Peter Diamandis was really kind of the key author for it. Just talks about all the medical advancements that they're making and like how rapid, what life is going to look like here pretty soon. It's very interesting. So I'm excited to pick that one up.
Wow. I'm going to have to Life Force. I'm going to have to put that because I'm fascinated by it as well.
Yeah. So I go to a coaching organization called Strategic Coach, and Dan Sullivan, the guy that started it, wrote a book called How I Plan to Learn to 137. And, one of my coaches, it's like, you really need to kind of have a financial plan to live to like 120, 150, because by the time our generation gets there, that may be realistic. And if you have a financial plan to live to your mid 80s or 90s, like you might be out of money for 30, 40 years.
Gosh, that's a wild concept to think about, but you think about it and it's like personalized medicine, right? Like literally medicine that only works for your genetics and no one else's. It's fascinating.
Yep.
If you could have any superpower, what would it be?
Oh, man, that's a tough. It's so funny. I've got a 4-year-old son and he loves superheroes. So I'm just like, my mind's like going through that. I mean, okay, so the Hulk is his favorite, and I've never been as strong as I want to be. I work out like 4 or 5 days a week, and I never can get to Hulk status. So I would say Hulk strength, because that would make my son love me the most.
I love it. That's awesome. Not many people love the Hulk. I love that. He deserves love.
He loves the Hulk. He got a Hulk costume and just wears it around all the time. Big Hulk fan.
That's awesome. I love it so much. Awesome. Last question. What's the best way for people to get a hold of you and learn more?
Yeah. So we're an open book. Our website is www.alinecapital.com, and swilliams@alinecapital.com is my email. And then, my contact information for phone number 864-729-3990. Give me a call, shoot me an email. Happy to have any discussion. I tell people all the time, I'm not a salesman. If you call, I have 0 sales in my body. If you call me, want to talk about a deal or want to talk about a concept, I'm here to have that conversation. I won't call you 10 times until you do a deal with me and try to jam something down your throat. So if you ever want to pick my brain and what we're seeing, please feel free to call me on the free phone call.
I love it. That's awesome. Such a great resource. Obviously, you guys, so much value here. Scott, thank you so much. I really appreciate it.
Yeah, thanks for having me.
Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.